We've got so much more hitting the markets at this hour, so you know what? Let's just get right to the floor show. Joining me now, Interactive Brokers Chief Strategist Steve Sosnick. Steve, from the look of the markets, yes, we don't want to diminish any losses here, but I mean, under 400 points loss on the Dow Jones Industrials, and some of that is due to stock stories, not necessarily what's going on in Iran. Does that surprise you? It's sort of like the market is yawning.
Yes, I've been surprised by this all along, Liz. It's great to be here, by the way. My thing about this is I spent over 25 years as a risk manager, as a market maker, that sort of thing. One of the big black swans that we always planned for, but you hoped would never happen, would be a closure of the Strait of Hormuz. The scenario at that point would be crude oil, $150 to $200 a barrel, and stocks with an immediate 10% correction and then getting hit harder after that. Well, we haven't come close to that, and that's a good thing, certainly. But what it tells me is there's certainly a buy-the-dip mentality, a buy-the-dip enthusiasm. People are still residually remembering post-Liberation Day rally that we had almost a year ago to this day. And I will stipulate that we're not likely to get that sort of face-ripping rally that we got then, and I'm happy to explain why.
Okay, so people who are expecting that history will repeat itself from a year ago, April, when the market dove, I mean, face-planted, kneecapped the day after Liberation Day tariffs. You don't see that happening if somehow the Iranians come together with the American negotiators and say, okay, nothing's going to happen at 8 p.m. Eastern, we're still talking?
First of all, I'm hopeful for that because I think we don't want to root for any human costs here. But the situation is different because we didn't have that sort of face plant. At that point, we were down almost 20% on the S&P 500. People were preparing the headlines, S&P enters a bear market. We got maybe close to down 10% on this one. So as a result, we haven't fallen as far, so it's harder to think that we're going to bounce back as quickly. The base case right now, when I look at S&P options, they're pricing in about a 3 to 4% rally by the end of next week. So we're still thinking, the market is still pricing in this bullish residual reminder, and it's a different situation. The tariffs could be unwound with the stroke of a pen. They were an executive order, and they weren't even implemented. He could change them. At this point, it's very hard to unring this bell. It will take weeks, even if everything closes tomorrow, everything finishes tonight. It will take weeks for everything to get back to normal.
Okay, well, right now the S&P down 50 points, 0.75%. All of the majors are on pace to snap 4-day win streak. So again, there is some definite elevated nervousness.
Indeed.
That said, let's just get people some headlines here when it comes to the oil situation. It really feels like the Iranians, if you believe the Iranian state media, that they are targeting Saudi Arabia. They have made all kinds of promises in the last couple of hours saying that if the United States starts to bomb the bridges and the power plants and, quote, end civilization in that country, they will target Saudi Aramco's oil operations. They will target pipelines in Saudi Arabia. I mean, maybe we can show the Middle Eastern map so people get a sense of exactly where this might be. And how would that be absorbed by the markets?
Markets would hate that, and understandably so. I mean, the problem here is that it's a relatively small place. I mean, the Strait of Hormuz is 20 miles wide. I don't know to the extent that either Iran is credible or that their military can do this kind of stuff. I'm not going to pretend to be a military analyst right now, but were this to occur, this would take out more of the production. We've already had production losses. If there's a raid on Karg Island, that would take out some of the production. This is the problem. It's not necessarily going to rebound tomorrow if the hostilities start.
On top of everything else we've just laid out, there is a Fed head speaking. Austin Goolsbee, the head of the Chicago Federal Reserve Bank, was speaking today, and he had some pretty worrisome comments. This is somewhat obvious. It has to do with spiking oil and stagflation. And in essence, what he said is that he said we've got to get our heads around the oil shock, and that oil prices rising is a stagflationary shock. His immediate concern is this stagflationary shock, that means stagnant growth, but inflation shock, spike of oil prices before the tariff-related inflationary shock has dissipated. What do you buy in that case? Is there a sector that you say, okay, this looks good?
Well, first of all, I put out a piece last week called Dude, Where's My Rate Cuts? Because basically the market had gone from pricing, call it 2.5 to plus a half of 50% chance of a third rate cut for 2026. They're gone. So That's gone, and that's pretty much gone around the world. Most of the other
because of the spike in oil.
Yes, most of the other central banks, what you see is pricing in somewhere between 50 and 100 basis points of either not cutting or outright raising. That's a tough situation, and that does speak to the stagflation. So what I think you want to do in a stagflationary environment, and I know Jerome Powell sort of poo-pooed the term at the last FOMC meeting, but while we're not looking at 70s-style stagflation, at least not yet, I think in those situations you want to be defensive. You want to find low beta stocks with dividends that can be supported by cash flows. They don't need to go out and borrow money to pay the dividends. And I think that provides a bit of ballast to your portfolio. Quite frankly, if the last few days have made you too nervous, raise cash, because your stomach is telling you that you've got too much risk on.
Okay, so you like high dividend names, and we've got some on the screen. You pick sectors, but if you mushed all of these together, there are a whole bunch of ETFs out there that band together so many of these names so that you catch a little bit of a yield here. So that makes sense. You get paid while you wait.
Exactly. That to me, again, I can't recommend specific names. You have some on the board. Those are all the kind of names that would come to me in a situation like this. But this is the way I think about it, is sometimes you want to be paid to wait.
Why are they all down then?
Because everything's, today things are down. Look at the names you highlighted at the beginning of the show. It was Apple, Walmart was down at the bottom of the list. Some of these stocks, which seem safe, are actually quite expensive. Walmart's got about a 45 PE. It's not cheap. Investors
aren't even looking for protection. They're not shifting money out of certain stocks and into protective stocks and ETFs?
Here's the crazy thing. The most actively bought name on the Interactive Brokers platform over the last 5 days was VOO, which is essentially the S&P 500, just a lower cost version favored by investors as opposed to SPY, which is favored by traders. No, to some extent, we haven't really seen that. Now, our customers tend to be a bit more aggressive, so I found it noteworthy that they were buying a buy and hold type of name. But this to me is we still see reflexive dip buying. Nike and Tesla were two of the most actively bought names last week. What do they have in common? They got hit hard. Yeah. And so people that behavior is still ingrained in people.
All right. Good to see you.
Great to see you, Liz.
He does not expect a face-ripping rally. And you also say you wouldn't buy more energy here.
No, I think it's not wrong to hold it. It's not even wrong to take some profits if it's become a big piece of your portfolio. It's a tough one to chase at these levels.
Steve, onward, my friend.
Thank you so much.